Hello and welcome to the October 2024 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joined with me today is my partner, Mark Zavitz. Today, we're going to keep things short and simple. We're going to give you a quick market update before talking to you about how much your portfolio can go down and will go down at some point. So let's get started. Well, returns have been great. Here is a snapshot of the S&P 500 index going back 25 years, which consists of the 500 largest companies in the US. And if you look to the far right, you can see over the past year or 2 years, market returns have been fantastic since we hit our lows. Most clients who are in our models, most clients who are in our models, you're up around 10 to 20% year to date. And over the past year, you're up somewhere between 12 to 25%, again, depending on which model you're in. The S&P 500 makes up about 50% of your stock allocation. It's been an amazing year to own the S&P 500. In fact, this year in 2024, the S&P 500, I think it's made around 40 new highs already this year. And in the past year, if we go back to October of last year, it's made 60 new highs. Those are days in which the index has beat its previous new high record. But why? What keeps driving these amazing returns, not just in the past 2 years, but over time? Well, there's been a few things. Technological innovation, AI, growing company earnings that justify higher valuations. So when we're doing earnings forecasts and the analysts are looking at what a company is likely to make to justify its current stock price, well, it's been around a double-digit earnings return expectation. Well, earnings are coming in now and they're all double digits. And the other thing that's been driving these returns has been immigration, increasing populations of working age immigrants coming to North America through immigration. It's creating a really strong consumer. The result has been, low unemployment and a very, very good economy. Even in Canada, where a few months ago we were talking and saying, it's looking like Canada is not the economy of Canada is not looking too good compared to the US. And that was true for a few months in the summer where it seemed to be struggling, and we kicked off our rate cutting cycle ahead of the US. But recent data in Canada, all of a sudden, it's looking like it's 180. Like Canada's all of a sudden looking strong again. Mark, you've always got a good finger on the pulse when it comes to these things. What do you think is the reason for why the market continues to make new highs and why things are looking so good all of a sudden?
Well, Greg, as you mentioned, most of the variables are pointing in the right direction. We've got inflation's back down to 2% in the United States and in Canada, and working its way to that point in Europe and Britain. We've got, as you said, low unemployment, strong economy, but not too strong. Just strong enough to provide a reasonably strong consumer base and lots of consumer confidence. And that's helping the companies with their earnings. The earnings continue, like you said, to come out. Not all companies, but we're looking at the better part of a 10% increase in earnings, and that's going to support higher stock prices. It's just the way it works, right? It's a Goldilocks scenario. The only challenge probably is we got a bit too much debt.
Yeah, yeah, yeah. We do have a bit too much. No, you're right, and it's it's funny. You think about what's potentially going to unfold in the U.S. election ahead of us. Like this is the definition of a strong economy here. So there's like a disconnect between what people are feeling and what's actually going on in the States. If I'm not as old as you, Mark, but would you say this is like one of the strongest US economies you've ever seen?
Oh, well, they just keep beating all the expectations. Like, we're not running at a 4.5% GDP, but everyone was projecting, a recession, or certainly stagnation, economic stagnation. They were looking at not very long ago projecting,
Flat.
0 to 1% GDP growth, and
Yeah.
we're three. Like it's significant.
Yeah. Anyway, so all this stuff has resulted in amazing returns for all clients like you, and I don't foresee any reason for why that can't continue into the near future. So here's another way of looking at the previous slide, but this slide, of the S&P 500 goes back almost 100 years, includes total returns of the S&P 500 by calendar year. Makes up, again, the S&P 500 about 50% of the stocks in your portfolio. But what I'd like you to focus on, if you look at this slide, are the negative years as seen by the red bars. Now, a full market cycle, if ever you hear us talking full market cycle, it's around 7 years. And on average, market returns go negative once every 5 to 6 years for about a year or two. Why is this important? Well, we're coming out of a period over the last 15 years of tremendous economic growth, primarily driven by those factors we were just outlining, immigration, technological advance, earnings multiple expansion. But we haven't had any major long-lasting corrections. And that doesn't mean we're going to experience one like a long-lasting correction at any point soon. Just take a look at, say 1940 to 1970, where at worst the S&P 500 finished down the year 10%. I think we're going to continue to see some great returns over the next 10 years, but at some point we're going to experience another major decline like we did in 2001 or in 2008. And that major decline will take on average 2 years for us to recover from. So I want us to start almost brace. It's like brace for impact, okay? It's going to come at some point. I don't know when it's going to come.
Yeah, Greg,
Here,
Greg, that's the key. Is
yeah,
it's not if there's going to be a correction.
yeah.
It's when,
That's right.
and it's
And when,
healthy. I mean, I'm not trying to put a positive spin on something that's quite traumatic for people, but it's healthy. The market needs to correct so
yeah,
that it can move forward again.
yeah, exactly. There's typically something that is overvalued. Something's disconnected. There's too much money in a certain area driving certain types of returns. And in essence, things are too frothy. And the froth just needs to come off. And that's typically what happens in all major downturns. The froth goes away or goes bankrupt in some cases. And then, the market resets and starts making new highs. Here's an example of our most recent downturn we experienced starting, end of 2021, beginning of 2022. And it took almost exactly 2 years for us to make new highs again. Now, this isn't a major downturn. It's kind of it was like an average downturn. This slide does highlight something, though, that I like to point out, and that is, and I pointed out to many clients before, asymmetric returns. So in this example, if a portfolio goes down, or if, in this case, the S&P 500 went down 25%, it had to return 34% just to get back to even, which is why for most clients, we advocate for them to be in a balanced portfolio that's not 100% stocks or the S&P 500, where there's lots of volatility. And because of the volatility of those stocks, 90% of our clients, so clients like you who are tuning in and listening to our update, you fall into one of the following three models. You're either in the very conservative model, you're in the conservative model, or you're in the moderate portfolio models, which are considered balanced portfolios with a combination of stocks, bonds, and gold in them. I've listed on this slide what these models should return in terms of long-term average. And I've also added a column that shows how much the portfolio would have gone down in 2008, as noted in the max loss to peak. So max loss peak to trough. The reality is, at some point in the next 10, 15, 20 years, while I'm looking after you, Your portfolio is likely to decline this much, and it will take probably 2, maybe even 3 years to recover. But you know what we're going to do when that happens? Nothing. We're not going to panic. We're just going to ride it out. And after we've recovered, that's when we should have a discussion about your risk tolerance or your risk level, if indeed the decline that we saw was too much, and make some adjustments at that juncture. So with that, I want to say thank you so much for tuning in and listening to our update. In our last update, we spoke about election outcomes and how that's going to affect your portfolio. And just as a reminder, it looks like regardless of who becomes president, we're going to likely have a split mixed Congress where Republicans and Democrats hold one body, one might hold the House, the other one might hold the Senate. And that means stocks are going to have some great returns. And typically what's happened in the past with a mixed Congress, regardless of if it's a Republican or Democrat president, the S&P 500 returns 2 or even 3% above its long-term average return. So long-term average return is around 10%. We could see around a 12, 13% return next year in the S&P 500. Who knows, but it's good for stocks. Thank you so much for listening to our update. We look forward to giving you our next update. Cheers, everyone.
Bye, everyone.